Hi, I'm Tony Turner, and I'm excited to share some very exciting and revealing information with you today. But first, please take a few moments and review this disclaimer for your safety and mine. I've been teaching traders and investors for more than a decade, and I want to share with you some of the troubling things I'm seeing right now. Many traders get into the market with virtually no education at all. They watch programs on financial TV channels and think they have enough knowledge to be successful, but they are making a huge mistake. They think that getting a few tips from a TV talking head will help them reap profits. Sure, they may get lucky here or there, but they have virtually no knowledge of how the markets work. They don't understand the most basic concepts that successful traders rely on. And they certainly don't have a profit strategy other than watching another hour or two of the TV guy. Now, you and I both know that traders who get involved in this type of blind trading will get blown out of their accounts and fast. They're also the ones that later tell others that the stock market is a scam and an impossible place to make money. Again, their ignorance keeps them from succeeding. There's another group of traders and investors who realize that getting educated is an important step in becoming successful in the market for the long term. They may take a course or do research on their own in an effort to get their education started. They begin learning how the markets work, some of the important terminology, and they do understand key concepts. At that point, they take their knowledge and they head into the market to start buying and selling. But what they soon discover, of course, is that knowledge by itself doesn't get them very far. Because the market can move so quickly, they need a strategy built on top of that foundation of knowledge. It may sound obvious, but it's surprising how many traders jump into the market without a clear strategy. Now, what do I mean by strategy? It's simply a systematic way of identifying good potential trades, evaluating the profit potential for the trade, knowing the right time to enter that trade, and then when to exit. It sounds simple, but I'm always surprised at how few traders actually use a consistent strategy. So those who do use a strategy typically do far better than those without a strategy, simply because they can evaluate if it works consistently. And if it does, they have a reproducible system they can follow over and over. The third thing I find troubling right now may not seem like a big deal, but I'll explain why after I show you what it is. It is the trader who's following all the rules, yet is leaving a lot of profit on the table. They have gained a trading education, they have a basic understanding of how the markets work, and they are even following some sort of strategy to find pretty good trades. At the end of the day, though, after all that work, they look at their account statement and wonder why there isn't more money in there. They're finding some good winning trades, but the amount of profits they're pulling out isn't as big as it could be. For example, let's look at this chart of ADP. Traders who bought after ADP bottomed out last November, right down here, but then they rode the first leg up, in December, right up to there, but then the pullback here in the rectangle would have taken most traders out. Most traders would have set a stop and left at that point. Subsequently, though, ADP gapped higher the first of the year. That if the traders had already left, that would have intimidated most of them to getting back in. But then the stock soared another 18 points, or nearly 14%, to its recent highs. This is the portion here from the first of the year that many traders left on the table. On the next chart of Mattel, we can see that Mattel also bottomed out in November. Now those who entered down here, probably right about here, they enjoyed a mild ride higher, but then Mattel pulled back right after the beginning of the year, retraced and pulled back pretty dramatically here in the month of January. Now, a lot of people would have gotten out there, actually taken a loss if they didn't have a good entry, and then they would have gone on to greener pastures. Many of them didn't notice that price turned once again and then soared 22% to its recent highs. All of this down here can cause traders a lot of aggravation. Then they leave and they miss out on the most important move up, 22% profit, not bad. Now, I decided to study this group of traders, the ones who make quick gains and then exit, to discover why their profits aren't higher. These traders were using a variety of strategies that were really pretty good. The thinking behind them and the methods that they were using were based on solid principles. After digging a bit deeper, though, I found something really startling. The one thing that most of these strategies had in common is they were very constricting. They were very limiting. In other words, these traders were using tools to find rock-solid entries on confirmed moves, and then they would lock in profits as quickly as possible and exit with those profits secure. On one hand, that's a good thing, right? They were only entering a confirmed move and they were locking in profits. That's a good thing. But the thing is, most of these profits were quite small, which means that in order to make a decent amount of money, any money at all, you would need to make a lot of those small winning trades each month to make it worth your while. Besides, when you trade like that, it presents another problem. Finding and executing more trades like that takes a lot more of your time, a lot more of your energy, and more money spent on commissions. How do I know? I've been there. I started trading in the 1990s when day trading was all the rage. Now, I had been a successful investor, and I thought trading would be similar. I paid for a seat in a trading room in New York, and we all sat and traded like crazy all day long. On one hand, it was a great way to learn how the market works. But there was a downside. I remember one day in particular, I executed nearly 50 trades that day, and believe me, most traders executed a lot more than I did. Anyway, after the market closed, when I went over my trade sheet, I found that most of my trades were good and I made a profit, but after I subtracted commissions and slippage, I ended the day with a net loss. This happened time and time again. Now, after a while, I moved more to swing trading, holding stocks for an average of 2 to 5 days, and my profits increased. Still, while I exited to lock profits at the end of a price swing or an upswing, I would then watch many of my target stocks continue to rise without me. Which brings us back to this important question. Why don't traders capture more of these available profits? We've seen how typical trading strategies are only allowing them to take a small percentage of a trend. What is holding them back from taking more? It comes down to these two things. Number one, you need new knowledge of how to better identify the start and end of trends. Number two, you need more confidence in your ability to identify those points before others, before the competition. Now, when I've explained this to some of my students, they've asked this honest question. That's all good and well, Tony, but what about when the market is sideways? What do we do then? Now, I am sure you've heard of sector rotation. During every market environment, certain sectors thrive and others dive, which means there is typically plenty of opportunity to find strong trends in both stocks and ETFs. And even when the broad markets are moving Sideways, it's not difficult to find individual stocks or ETFs that are building their own trends for their own catalysts or for their own reasons. In other words, there is seldom a lack of trending opportunity for any type of trader. But if you listen to a lot of the supposed market experts, they say it's next to impossible to catch these full trends. You may have even heard them talk about this before. In my next video, I'm going to show you why they're totally wrong. You'll even see why that line of thinking is not just lazy, it can be even dangerous to the wealth of serious traders like you. You'll also get clear examples of how easy it can be to catch and ride these full trends. Plus, you'll see how much more you can be profiting from your trades even if you're only getting in on half of a trend. Imagine how your life could transform if you were able to double or even triple your current profit amounts per trade without increasing the share size or frequency of your trading. It's all in the next videos, so stay tuned.